So markets are anxiously awaiting the tariffs, which are set to go into effect on April 2nd, but I have missed some questions that were posted to me in the chat and in the comments section, and I'm going to try to get to those first so I don't forget them today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. So, I have repeatedly said to everybody watching, put your comments and questions in, and I will try to get to them. And if you don't get them answered during the live stream, if you put them into the comments for the video, we will try to review those and get to them. And there's been a couple that I think have popped up more than once that I haven't gotten to from PC and AAMTB. So I think I am going to try to address those now. The first one I'm going to go over. So one of the questions that I received, and I'm not sure I can pull this up on the screen, but the question was, your colleagues on Fast Money sometimes compare the price of the put versus the call to gauge skew. Okay, fair enough. That's how we all generally do it. Example, put or call that's $10 out of the money. Recently, I was looking at a stock, and when looking at implied volatility, there was call skew, but comparing price, there was put skew. Is price even a factor you use? Okay, so I had seen this question before, and I'm not 100% sure I'm understanding what you're asking, but maybe if I just go over how I think about skew and the different ways that I look at it, it will be helpful. So, first of all, just as a quick introduction to folks who are unfamiliar with the concepts of skew. And I'll go into a little bit of a history of options pricing. So when Myron Scholes and Fisher Black and also Robert Merton came up with an options pricing model in the early 1970s, they came up with a closed form solution, which became known as the Black-Scholes model. The idea was that with a single input of an unknown, you could price an option and understand some of its risk characteristics. And because most of the characteristics of an option are known or can be closely estimated, so we know what the price of the underlying stock is, we know when the expiration date of the option is, we know when what the strike of the option is, we know whether it's a put or a call. So those things are all known. The thing that we don't know, and what is used to model the value of that option, is the volatility of the underlying stock. The greater the volatility, in theory, if you don't know where the stock is going, the greater the probability that the stock can migrate to or through or even significantly through the strike price. And in this way, you can come up with a mechanism to price an option. And the way it was understood when that first happened was that implied volatility was a number. In other words, that you would understand how a stock behaved. You could take that implied volatility, which was just its standard deviation, a relatively simple thing to calculate. You could throw that into the model, and an answer would pop out. And they did that as a way to price options, for the most part, for more than 10 years. So call options were first listed on the CBOE, I think, in 1973, and puts were introduced a few years later. Actually, I had a friend of mine who worked with me when I was at Cantor Fitzgerald. He was also a trader at Bear Stearns and worked at Lehman Brothers also, who was a synthetic put trader, because before they actually listed puts, they would create them synthetically, and that's what they did, up until the crash in 1987. And in 1987, options traders were confronted with a very harsh reality, which is that it probably isn't appropriate for puts on equity indexes to be priced at the same implied volatility as upside or at the money calls were. And it's really around that time that options pricing changed quite dramatically in equity index land. And that was that they recognized that volatility wasn't necessarily a continuous process that could be defined by a single number. There were other characteristics to the price behavior of the underlying asset, and the models didn't deal with that very well. So what options traders did was they would try to basically see how the process of the underlying stock price or commodity price did not behave as if it was normally distributed, and then they would essentially bid up the puts and then offer the calls a little bit better. And because volatility, the implied volatility is the input that they put into the model, in order to jack up the price of the downside puts, they would increase the implied volatility there. To reduce the upside calls, they would reduce the implied volatility there. So now, when you looked at an option model, suddenly you wouldn't see a volatility. You would see a range of implied volatilities depending on the strike of the option. And that characteristic is something that we now, in the options context, refer to as skew. It has a statistical connotation as well, which is that because things are not normally distributed, and this is basically where it's going to get its name, because they could have called that anything. You know, they call it a volatility smile, but why do they call it skew? The reason is because it has a statistical basis, and that is that if a distribution is not normal, it can have negative skewness or it can have positive skewness. And so if it's negatively skewed, then you will see the puts bid up, and if it's positively skewed, you would see the calls bid up. So you'll often hear options traders talk about this. The question then is, how do we think about it, though? Because as this viewer asks, it's definitely true that in some cases people will come up with an example. And actually, I'm just going to use options play really quickly to illustrate something like this. Oftentimes, when you're looking at a specific underlying asset, you're going to think about it in terms of that underlying asset's price. But there are other ways to think about this, right? So you can think about it in terms of price in dollars. You can think about it in terms of price in percentages, up 5%, down 5%. Or you can think about it in the context of something that makes a little bit more sense to an options trader, like up one standard deviation or down one standard deviation. And options traders will sometimes use standard deviation or sigma somewhat interchangeably. And actually, it looks like we're getting a follow-up on this question. To clarify my question, I was looking at Uber. So we're going to pull up Uber. At the time, the price was $75. It's obviously not $75 now. The price of the 65 put was 70 cents. The 85 call was $1.20. Call skew. Aha. Not necessarily. But the implied volatility. Okay. Now I understand what you're saying. Yeah. Okay. So this is a really important concept to understand. So the value of an option is going to be impacted by the strike, the price of the underlying, the amount of time to expiration, the implied volatility, and carry costs and things like that. So when you're looking at this in dollar terms, like, for example, a $10 out of the money call is $1.20, and a $10 out of the money put is 70 cents, there's more going into that than just the implied volatility. Two of these come immediately to mind and can have a very big bearing on an option's price. The first is that the value of the option is determined in part by the strike. All else equal, a lower strike is going to have a lower options price. And I'll use an argument ad absurdum to illustrate this. You can imagine that if you're looking at the S&P and the S&P is 5,600 and you're looking at Uber and it is $73, if you take a $10, if you take a call that is, let's say for the sake of argument, $6,000 on the S&P and $75 on Uber, obviously the call option, even with a much lower implied volatility in SPX than Uber has, just as a function of its price, or the strike, is going to be much, much higher. So that's the first thing. The second thing that can play into this, and this gets a little bit messy because it's going to vary from one regime to another, and it's going to vary from one underlying to another, and that is the cost of carry. So the higher interest rates go, the higher the value of a call is relative to a put, all else equal, because you can own the right to purchase the underlying without actually laying out the cash to buy it. And using that cash in a high interest rate environment has a higher carry cost, right? So that's the first thing I would say. By the way, I just lost audio to the producers on the East Coast. I'm not sure whether I just accidentally yanked my cord out or what, but I will wait for them to send me a text message. Okay. So that's going to play into it. So the strike price is going to have an impact, and interest rates are going to have an impact. And this is not something probably that a lot of people have observed in recent years because interest rates have been pretty close to zero. But as short-term rates have risen, and usually we're dealing with short-term rates, right? Because, you know, you might be buying a one-year call option, and the cost of carry is the risk-free rate on that cash over the course of a year. So, you know, that has approached 5% or so in recent years. So that's a pretty material impact. The other thing that can impact it, of course, is the dividend, except in the opposite direction. Because if you own the stock, you receive the dividend. If you own a call option on it, you do not. So that is I understand why you asked the question and the way you're thinking about it. And the reason also is because this goes into what it would cost to own, for example, a zero-cost collar to protect your underlying asset. I'll give you an example. And I think I illustrated with this example before. We can actually, you know what? We've got Uber up, so why don't we just leave Uber for now? So what I'm going to do is I'm just going to go out and take a look at next January's options. Let's say you have a position in Uber, you want to protect it, and you want to hold that option, you want to hold that stock through the end of the year for whatever reason. And what you're trying to do is sell an upside call and buy a downside put so that you have some downside protection and still have some upside participation. So if you're going to sell an upside call, and let's just take a look here, and I will choose, I'm going to start with a 65, 85 for now. And you'll observe that the stock is about $73 and the downside put is $5.95. And the upside call is $6.83. Now, if I add stock to this so we can see what that position would look like, you get something that looks like this. You have more upside than downside, or at least that's what it looks like, right? And the reason for that is that you've put this trade on, you've collected money to do it, right? In this example, you're selling a call for $6.83, you're buying a put for $5.95. So we'll say you're collecting about 85 cents net of transaction costs, and assuming that you don't get it off quite at mid-market. So you're going to collect 85 cents. You have downside from $72.90 to $65, which is $7.90, and you have upside from $72.90 up to $85. And so by the looks of things, it would appear that you've got $12.10-ish worth of upside. So that asymmetry seems, you might look at that and say, oh, well, there's call skew because this call costs more. Its price is higher than that of the downside put. But is that actually true? Well, no, actually. The implied volatility is how options traders will think of skew. What is playing into this is, in part, the cost of carry. How much is the cost of carry? Well, there's 291 days to go until expiration. So let's just see really quick. I'm going to actually look at what the options market has for Uber's January risk-free rate. So for that, I'm just going to quickly advance out to the January options, January 2026. And the risk-free rate that's being used there is 4.3%. So now let's just think about this carry cost question for just a moment. So you have 291 days to go out of 365, so it's about 0.8% of a year times 0.043%, which is 0.0343% of, and we're just going to use round numbers, $73. That's $2.50, okay? So that's $2.50 worth of carry costs. That's the amount of money that you have to spend to purchase the shares, money that you otherwise would have received interest on. So if you factor in that carry cost, now the fact that the put costs less than the upside call does begins to make more sense. And perhaps if I illustrate it a different way, this will make even more sense. So let's get rid of the two different options for just a moment. And we're going to create the same trade synthetically. In one case, I'm going to buy the stock and I'm going to buy a put to protect it, which is going to give me a position that looks a lot like a call option, as you'll see. So we'll just go like this. And I really appreciate the fact that you clarified your question, because I think this is an important concept that everyone should probably, it's not critical to be able to do every bit of this math, but it's just important to have a basic understanding of the things that drive an option's price outside of implied volatility, particularly when you're going further out in time. So here we have a January 75 call. Okay. Now, if I come over here and I said, okay, I'm going to buy the January 75 put and own the stock. Okay. So I'm long stock, long 75 put. That should give me, now you can see that these two positions should look fairly similar. You see that? So, of course, this kink is going to happen at the strike. This is my 75 call. And we can see here, and let me just make sure I'm choosing a mid-market price in both cases. Okay, so let's just keep track of this. So this call is $10.73. Okay? And this put is $9.82. This put is in the money, right? Because the stock's $72.90. So this thing right here is $2.10 in the money. And so it would certainly seem, when you look at this, that this trade is more attractive. But in this second trade where you buy the stock and you buy the put, you have to lay out more money. How much more money? Well, it's the difference between this price, $8,258, because each option in this case has a multiplier of 100, and $1,073. So put differently, you're going to have to use about $7,200 additionally in cash for 291 days. So I hope everybody's kind of following along with this so far. So 7,200, as we said before, that's going to be 4.3% interest times 0.8. So that's about $250 worth of interest. Okay? So, which works out to the exact same thing we were just talking about before, about $2.50. So it's an important consideration to understand that interest rates can affect it, but this doesn't necessarily have any impact on the trade you do. And let me give you an example of why. Let's say you were an employee of Uber and you were allowed to hedge your stock grant. So you were granted stock and you were allowed to hedge it, but you didn't have any intention to sell it because that would do other things, like give you some screwy tax consequences. So you decided to put on some trades that would help hedge that. Or you held it in some mechanism that prohibited you from selling it. Well, the carry cost is something that doesn't apply to you necessarily because you've already established that you're not going to be selling the stock. So in that case, putting on something like a zero-cost collar, the fact that interest rates have risen will make the trade more attractive to you. You were going to hold the stock no matter what. You were never going to get any interest on whatever the stock's value was. But as interest rates rise, increasing the value of calls relative to puts, all else equal, what's going to happen is that if you wanted to put on a collar at zero cost, you're going to be able to raise both strikes, the put strike and the call strike, and you'll get an asymmetric payoff, kind of like you see here. So skew, we like to think about it as an options trader. You want to think about skew in implied volatility terms because that really tells us more about, we can relate the value of options through time more appropriately this way. Let me give you an example of what I mean. So I'm just going to look at it in terms of tenor. I'm just going to look at SPX right now. Oops. Thought I was going to do that. Okay. So, and I'm not going to use listed. I'm just going to go by, we'll go over here, skew, and I want to look at this. Okay, so another quick point. When you hear options traders refer to skew, they will sometimes talk about it in moneyness terms, which is what I previously articulated, which is percent, up 10%, down 10%. If you're using just strict moneyness, up 10% will be called 110% moneyness, and down 10% will be called 90% moneyness. That's how it will be reflected on my screens, and that's kind of a common way to think about it, but it's, just so that you understand. That's what percentages are. Sigma, as I also said at the outset, is just thinking about it in standard deviation terms. And that also helps me normalize things, because remember that the standard deviation over a week, a month, a quarter, or a year, all of those in dollars are going to be different. But in standard deviation terms, it gives you a mechanism to normalize it. Okay, so let's just take a look. Right now we're looking at the skew in sigma terms out 3 months as of today. That's the one in white. And why don't we go back a whole year? I think I'm going to go back a whole year here so we can compare the same day, March 31st of 2024. I'm not going to do that because that's a Sunday, and that Friday was Good Friday. So why don't we go to April Fool's Day? That's close enough. And now we can see this is going out 3 months. So this is 90-day options in the S&P. We can see that the overall level of volatility is higher right now than it was. We can also see that the puts are higher in implied volatility terms relative to the calls, right? So call volatility is higher than it was a year ago by, so up 1 standard deviation, we can see that it went from 10.9-ish a year ago to 12.8, all right? But if we go down 1 standard deviation, we can see it went from 15.3-ish to 22.3. Okay, so we can see you don't want to think about things just in terms of dollars unless you're going to do the work of extracting out things like carry cost. And to do that, you're going to need to know the risk-free rates. It might also be important to know that there can be different rates depending on one's condition. So, for example, if everybody's in a short position, you could see things get really screwy if a stock becomes hard to borrow, because then you have a long rate to think about and a short rate to think about. So it's much nicer to be able to just get rid of all that noise and just think about it in implied volatility terms. Okay? So you can use implied volatility as your barometer for skewness, because you can relate that through time in different volatility regimes and also in different carry cost regimes. Otherwise, what's going to happen is if you're looking at a stock that pays a dividend that has the same implied volatility as one that doesn't, and you're thinking about it as strict dollars, you're not going to be able to compare it one to another. It's not really that meaningful, because there's these underpinning other variables that are going into it. Implied volatility is the way we think about skew, but it will be referred to sometimes in terms of moneyness, sometimes in terms of sigma, sometimes in terms of delta. And I'll just flip these back and forth. So a 25 delta call versus a 25 delta put. And I'm going to just show you what these things look like. And you're going to see that shape's going to be a little bit different. And if I use moneyness, things get a lot wilder, as you'll see here. Okay. And this is, when you look at things in moneyness terms, so we're going way out on the curve here. So 250% out of the money. That there's even an implied volatility here, it's not a real number if you think about it. These options are all worthless. On the S&P, a 3-month option that is struck at 13,000 or 14,000, that option doesn't really have any extrinsic value. But this is just a smooth and interpolated or extrapolated number. Okay, so I hope that helps a little bit. But it is definitely true that if you have an underlying position and you're trying to collar it, then these things can be more beneficial in environments like this than they are in other ones. In fact, I actually was just dealing with a family that had, I was talking to them, that we didn't end up doing anything, but they had NVIDIA was substantially higher at the time, but they were interested in hedging a big block of NVIDIA that they had, which was an understandable desire, stock that they had received as employees of the company. And, I pointed out, I said, look, you can collar your position out a year or two if you're planning on holding it indefinitely and get very asymmetric payoffs. And it was not their intention to sell the stock. So the fact that rates had gone up just simply meant that they were going to be able to sell a higher out of the money call and buy a higher strike put and get a very favorable risk reward characteristic on a big block of stock. And they were never going to receive the interest on that money anyway, because they weren't going to sell the shares. Anyway, so hope that helps. PC says, could you walk me through your typical process for determining when and how to implement SPX hedges, including the key market indicators you monitor? Okay, so, well, one of them certainly is volatility itself. So if volatility is high, there's a decent chance that it's, right now we're well over 20. I'm less likely in an environment like this to be hedging aggressively because the cost of hedging has increased considerably, and also because, generally speaking, when this happens, this is indicative that the market has sold off a bit. Let me put this in so that we can relate that and you can see what I mean. So this is a chart of, I want that on a secondary index. Let's do this. So we're going to just put this in here. I'm going to have the price of the S&P in here. And what you're going to see is that the way I think about it is that if you are buying protection when the VIX is elevated, there's a good chance you're trying to defuse the bomb after it has already gone off. Now, this morning, the S&P was in a formal correction, meaning down 10% or so from its highs. And that's a big difference. There's a big difference between that and a bear market. But as I previously mentioned, I think one of the things I like to do as a hedge when vol is low is buy strangles and hedge them delta neutral. But I don't like to do that when implied volatility is high, because you just have there's a lot more ways to lose. And you're also, you're capping potential upside after the market has already given something back. So in a circumstance like this, if I'm really concerned about a pullback, this is a circumstance where I'm more likely to be using put spreads. Also, as we previously illustrated, right now, not only is vol higher at the money, but out of the money put vol is substantially higher and than it was, for example, a year ago. So not only is it going to impact whether I'm going to hedge, so if we're already in a 10%, I don't actually have any downside puts on in the S&P right now, for what it's worth, just so everybody knows. And I think I've previously articulated when I did have something like that on. But if the skew is steeper, that is also going to mitigate the cost of those downside puts because you're selling a higher implied volatility. So let's see if we can find an example. This was something else I was going to talk about, which is delta. Well, let's see. That's also related to delta. So I'm going to get to that in a second. When vol is low, so we're talking, VIX 15, sub 15, I like to use 25-ish delta, 20 to 30 delta strangles, let's just call it that, out 30 plus days, hedged, delta neutral. Now I'm not going to ask everybody else to do that, but let me just go through one so you guys can kind of know what it is I'm talking about. And then what will end up happening is if we get a gap down, I will often sell a lower strike put against the one that I am long to mitigate the cost. And I might roll my upside call down. But let's just imagine we were going to do this today, even though vol is high, and so I don't actually have it on right now. I'm just going to go out. I'm going to go out 30 days and give you an example. Again, vol's high right now. This isn't what I'm telling people to go and do, which is buy downside puts when implied volatility on these things is going to be in the mid-20s probably. But what I'm looking for here is I would normally look to buy a downside put of about 20 delta-ish, 20 to 30 delta. So let's just say, okay, could be the 5450s, all right? So I would buy the 5450 puts, which are 30 delta, okay? Now, to put things in perspective, these would actually be closer to a 20 delta in a lower volatility environment because their delta is a function of the implied volatility of that option. So let me illustrate what I mean by this. We're just going to look at this option first, and then I'm going to go show you the other side of it. So the implied volatility is about 21.5. Now, this is an option I would normally be looking to pay about 15 vol for. And notice the delta. It's 22. Okay, so that's this. If you didn't notice that before, highlighting it right here. Delta's minus 22. So we'll take it back up to about where it is now, about 30. Okay. So I would be looking to buy something like that, which is like the 5450 puts, and an upside call of comparable delta. So when I initiate the position, there wouldn't necessarily be any delta to it. So now we've got this 5450 put. I'm going to buy an upside call here. And where do we close today? 56.11. So okay. Now, this one, in normal circumstances, in a lower implied volatility environment, this would be much lower. This would probably be closer to 10, okay? So the put would be 15, and this would be closer to 10 in a low volatility environment. Take a look at the deltas of these options, and I need to adjust this vol again. And take a look, okay? So down here, this one's minus 22 delta. This one's positive 22 delta. Okay? So this trade would be delta neutral. And what I'm looking to capitalize on in the event that the market rolls over, having a hedge like this on, is two things. One is this trade is long gamma. What does long gamma means? It means that as the market declines, my deltas get shorter and shorter. And as the market rallies, I get longer and longer. But for the most part, this is a hedge. It is the downside that I'm more interested in, especially gap days. S&P, you wake up and the S&P is down 100 handles. You're going to have a lot more short delta on. And at that point, I can do a couple different things. I can spread the put side down, or I can buy some SPY. Usually, I'm just buying SPY to hedge the deltas. For whatever it's worth. So I could buy some SPY and look for a rebound. And as it trades back and forth, I can buy some SPY lower, sell it higher, sell high, buy low. Again and again, that's how you realize the volatility. But I wouldn't do it here, as I previously articulated, because now this thing has a lot of vega. Vega is how much this structure is going to change for a 1% change in implied volatility. If I thought I was going to buy a 15 vol put, and I thought I was going to buy a 9 or a 10 vol call option, all right, and instead, what am I actually doing here? That thing was 22 on the downside and 16 on the upside. So that's 6 clicks of all. Well, 6 clicks of all, this thing's almost 1,000 vega. So in round numbers, back of the napkin, this thing's going to lose, if vol just simply reverted back to where I thought it should be or would be when I would normally have this on, this is going to lose about $6,000 on a standstill basis. So to hedge at this point, instead of doing something like this, I would advocate putting on a put spread. So you can't put index into options play, so I'm not going to use that. I'll use SPY for this exercise. Okay. So let's just say I'm going to go out 30 days. I mean, I think people who are hedging right now are mostly hedging the potential exposure to tariffs. Now, what's interesting about that to me is that, I don't know why people are hedging an event The only thing you could be hedging is that the news will change, right? So that there will be a policy shift. It's not like there's some specific event that's going to happen when the tariffs go into effect that is going to have the immediate effect. I think the real uncertainty comes from, will there be a change, like a policy pronouncement change, which of course is possible. But let's just say I bought a 550 put and was concerned about, we'll call it, down to 500, something like this. So that would be more of the kind of trade that I would advocate in this environment if you are concerned about additional downside to hedge. So that would be a 5,500, 5,000 put spread in SPX. Like I say, I'm using SPY here because, and the thing is, if vol comes in, will this be impacted? It will be. This is long Vega too, but it's not long as much Vega because you are short an option as well as long one. And the other nice thing about a put spread is that it's going to kick in a little bit sooner than maybe that outright put would, because that strangle or an outright 30 delta put, which is a trade that I know Goldman Sachs had long promoted as kind of like the best way to hedge if you are interested in getting bang for your buck, is that you benefit from two things, and that is the delta. You get shorter delta as it goes down. But of course, if you get a big gap day, a price jump, implied volatility will jump, and you're going to win from that as well. Less so true here, but that's because partially the bomb has already gone off. So I hope that helps a little bit. Oh, yeah, and let me just elaborate on one other thing, which is that when I look at hedging, or when I look at whether I'm going to use spreads or anything like that for that matter, one of the other things I will do, and I might as well just bring up delta because I was planning on talking about delta in a little bit anyway, is I will look at certain levels where I suspect it's possible that we could bump into some measure of support, right? So for example, if I thought, oh, okay, well, this is not maybe going to be the world's best example because it looks to me like down around here is where the next level of support is. You're not going to be able to get much for selling a 30 strike put, but it helps illustrate the point. If this was a super high volatility name, much higher than it is, and you could get some downside value. MicroStrategy would be an example where you probably could get some meaningful money for a 20% out of the money put. Then I might say, okay, well, I'm looking to buy a 40-30 or a 37.5-30. It would be in this neighborhood. In other words, I'm picking a range where I'm trying to mitigate the price movement within that targeted range. And I'm willing to accept risk beyond that. Okay, so just to summarize what we've just talked about, the steeper skew is the more appealing put skew, so negative skewness, the more appealing a put spread is going to be. I will look for potential technical levels, sometimes guided by fundamental levels. So I was actually just thinking about this today. To me, when people chart fundamentals or they think about ranges for fundamentals, that's almost in some ways another way of thinking about technical analysis. In other words, if you say, well, this stock typically trades with a PE of between 10 and 20, and we're trading at 12.5 right now, it's towards the bottom end of the range. Well, if I think I have a decent grasp on what earnings are going to be, what you're really talking about is another way of thinking about a combination of fundamentals and technicals in that context. But that's something else I would use to frame that up. Quantify stop loss or profit-taking criteria. So that's the follow-up portion to your question. Profit-taking criteria, in my case, because I'm trading delta neutral, or I'm usually hedging deltas on my hedges, I don't have a stop loss per se. What I am doing, though, is, so as a market maker, we typically hedged our delta at 1 times gamma. And I apologize again for anybody who isn't used to hearing me speak about the Greeks. But if I had 5,000 gamma, which means that for every dollar an asset changed, my deltas would change by 5,000 shares equivalent of the underlying, I would usually hedge that number. So if I got short 2,500 deltas on a 50-cent move to the downside, I wasn't hedging. But if I got down to $1, so I was short 5,000 deltas against 5,000 gamma, then I would buy 5,000 shares and get flat. That's a fairly common sort of rule of thumb amongst vol traders, I would say, those types of things. There were other circumstances too where we toyed with different ways to mitigate our transaction expense. Now, our transaction expense in the old days was actually, believe it or not, higher than it is for retail traders today. I can still remember when we thought we were getting a bargain, paying a penny and a half a share. Another thing we toyed with was hedging at specific times of day. So we would not do that on the open. We would not do that on the close. But for a while, I think for probably a 2-year stretch, to mitigate over trading, we were hedging, I think it was around 1:45 in the afternoon. So all of our positions, and we typically had about 150 to 200 underlying stocks, and then all of the relevant options on those. And we would just hedge everything to neutral, just after lunchtime each day. So everything would get flattened out. And then we would just beyond that, we would just let our, the risk accumulate until the next day. And then we would do the same thing. But I knew trading firms that didn't do it at all. Believe it or not. They wouldn't bother to because they thought the slippage was too great. They felt like they were getting whipsawed by trading too much. And so they were willing to take on more risk. Whether you're willing to do that is going to be more a function of your capital than anything else. In our case, we're using a lot of leverage, so we actually had to manage our risk day to day. Okay. I hope that helps, by the way. So the absolute dollars, that's not how I think about skew. Implied volatility is the way to think about skew. Different things impact the value of an option in terms of price. So, spicy barbecue. I did a 94.90 1/3 back put spread ratio on Micron. I made $500. Do you like back ratio spreads? I don't trade them myself. But that's not to say that I wouldn't or that you shouldn't. Whether or not you should is going to depend on, to a degree, on the setup. So let's just take a look at Micron really quickly and just sort of work our way through this one and give it some thought. So first things first, if you're going to do ratio put spreads, one of the things you're going to be interested in... Oh, okay. Yeah, so I'm going to construct one of these. Spicy, maybe you could just tell us which one you were in. I can just create one. So, first of all, as most of you who are watching know, you've certainly seen me talk about 1/2 put spreads, right? So, let's do something like this. Let's imagine that... So, whoops, this is not Micron. There we go. That's Micron. Okay. So I'm going to see if you are going to tell us which one you had on. But I'm just going to, again, use some mid-market prices. So let's just say, for the sake of argument... Oh, you did tell me? Oh, yeah. Oh, you did say that. Yeah, on the 90... Where did I lost the question? Oh, here it is. Oh, these must be weeklies because it's dollar strikes. Okay. Oh, I don't know which weeklies. Oh, let's go back. Let's go back this way. So you had 94 and you had the 90s. All right, so you can buy there's a couple different ways you can do this two ways. And believe it or not, depending on how you set the strikes, either of these could be bullish. If you buy one put and then sell 3 lower strike puts, okay, you end up with something that looks like this. It's a little bit like a buy right with a bump in the middle. So if you're targeting a specific price and you want it to run to that price, that's one of the things you could potentially do. When would you want to set it up this way versus the other way? You want to set it up this way when skew is steep, when you've defined a level at which you're really willing to get long a lot of the stock, which is what the risk is. If you're long 1, short 3, or whenever you're long one put and then short many more of that, whether it's 2, 3, or whatever. I knew people that have done these types of trades. A former colleague of mine was working at a family office, and he did a lot of this kind of stuff. He would do a deep dive on the fundamentals, establish levels where he was willing to buy a lot of the stock, and establish levels where he was willing to short the stock, and then he would try to get optionality in the middle. So he would end up in these kinds of funky ratio spreads, often looking out over the calendar. So if the skew is steep, which we were just talking about as it happens, right? So well above average, then this is a trade that gets more appealing. If the stock has fallen down to a level where you think that most of the damage has been done, but you want to make money anywhere higher up than where it is right now, and you even possibly believe that it could fall just a little bit more, then these kinds of trades could get appealing. And as you can see in this trade, which I just had up there, I'm going to leave it up, you can see that this is going to collect premium on a standstill basis. So you're going to actually just, you're going to make money anywhere to the right here. Your gains are capped, but, like that. So yeah, it's fine, but it's going to be case dependent. So you want to have steep skew. You want to be putting this on in trades where the stock has come back to a level where you can sort of find really identifiable, 1, levels of potential support, and 2, levels where you're really interested or willing to back up the truck and get long. Notice that the downside break even on this one that I've just illustrated here is about $83. And if we take a look at the stock price, if I can get to 6 months, okay, so that's going to be down around here, which is the lows. See? So that might seem appealing as well, right? So you're taking risk. If you think the stock is going to hold those recent 6-month lows, then a trade like this could make a lot of sense, and you're going to make some money in the intervening period. The one quick point I would make, though, about this is that depending on which trade you do, so if you're long 1, short 3, that can tie up a decent bit of capital, right? If you're in the trade the other way, and I can illustrate that as well, so if you sold and bought, and why would you do this? People will do this. You'll notice that these two trades are going to look very similar, but with a little bit more steepness, let's say, to a covered put, a short put, a buy right. And if you flip it up, then upside down, then it's going to look like a long put. So really what you're doing in trades like this is you're squeezing the balloon. You're being a little bit more nuanced about the price that you think that the underlying could potentially get to, and trying to maximize profits within a targeted range. You can see that here, right? So this is a situation where you might think, okay, I think the chances that it lands here is very unlikely. The chances that it comes over here is more likely. And so I'm willing to trade this somewhat worse payoff in this little dimple here in exchange for that potential benefit. And again, whether you're willing to be long a lot of downside puts or short a lot of downside puts is probably also going to be dictated by your perception, not only of the price of the underlying, but how high you think implied volatility is and how high you think skew is. If you think put skew is very high, you're more likely to want to be short that downside. So combining the fact that and that will, the nice thing is that oftentimes these things will coincide. And that is that if the stock has come in considerably, almost to levels where you're interested in buying the stock anyway, it's also very likely that the skew has tipped up. I have talked about this before, and I apologize because I'm giving this a lot of play, this particular conversation. But there's one other thing I want you to pay very close attention to, whatever stock it is that you're looking at with respect to put skew, and that is the amount of leverage on the company's balance sheet. Micron does not have a lot of leverage on the balance sheet. It's about $5 billion worth of net debt over $100 billion. That's not a lot. Okay, so there are plenty of other companies that are going to have way, way more debt relative to the overall size. Well, actually, that wasn't the best example. I should have used something like AT&T as an example. So AT&T, $200 billion market capitalization, but it's got $160 billion worth of net debt, right? So the skew, in theory, if you're thinking about this, as the price goes down, what's happening? The value of the equity relative to the debt is shrinking. The equity should, in theory, become more volatile. The skew should be relatively steep in a case like this. And there it is. You can see that it is, see? So bear that in mind. Another good example was, it's an example I keep going back to, but many years ago, before Apple started getting a lot more creative, and they were just accumulating cash hand over fist. At one point, 40 cents on every dollar of value in the share price of Apple, and it was trading at less than 20 times in those days, was cash. And there wasn't a whole lot of call skew. It wasn't a huge amount of put skew, but there was some. For some reason, it seemed like the market didn't recognize what was going on. Or maybe they did recognize it and they said, you know what these guys are going to do is they're going to start issuing tons of debt and do all of these cash buybacks, and so that cash isn't going to exist in the future. And so that may have played into, that is in fact what they did, and they were right to. Interest rates were very low. And they weren't earning any interest on the cash balance that they held, so they definitely were not doing shareholders a favor by holding massive amounts of cash. And that was truer for Apple then than it is for Berkshire now. And the reason is that in Berkshire's case, they deploy cash opportunistically, and they will even from time to time use it to repurchase their own shares when they think that it's trading below book. So, there's always a little, you can go down a rabbit hole thinking about all of these things, but just do think about the amount of debt or net cash on a balance sheet when you're thinking about skew and ratio spreads. Okay. All right. Steve Garcia, Bitcoin and gold aim to hedge inflation better than fiat. Amid fiat risks, debt, and inflation, gold rises while Bitcoin falls. Do people trust gold more than Bitcoin as a safe haven? Bitcoin has been trading like a risk asset, right? So as the market has sold off, so has Bitcoin. And and this is actually, Peter Schiff, who's a big gold bug. Some of you may know who he is. He runs, I think it's called Euro Pacific. I'm acquainted with Peter, although I have not seen him in ages. The last time I saw this guy was at a lunch in Dallas, probably a decade ago. But he's a big gold bug. Look, if you're thinking gold has been money longer than the dollar has, by a lot, by millennia. So, and actually it's funny that you should mention this because I was thinking about this today, and that is, so let's just take a look at the price of gold for a second, and its utility as a store of value. And I'm going to go, I don't know how far back this goes. I'm going to see if this goes back to 1975. I hope it does. It does. Nice. Okay. So why did I want to go back to the 1970s, this area here? And that is because the house that is in this direction from me, our next door neighbor, they have it was a retired couple. They had a couple of kids. Unfortunately, my neighbor, he died from cancer a couple of years ago. And they sold their house. They had bought their house in the 1970s. And I remember he and I had talked about it. He and I had actually played golf together. And he bought that house for, I think he told me $36,000 in the 1970s. And they sold it for $3 million after he died. So if you think about, it's the same house, they've done no work to it. Okay? There's no improvement. So we're talking about a period of 50 years, and in dollars, and that house is probably, it's been a couple of years since, and prices are higher, but We'll just use the 3 million number. Why not? So over the course of 50 years, it went up 83-fold. Right? Well, if you had used gold when it was $125 to buy it, it would have cost you 288 ounces of gold. Is that right? Yeah. And now, obviously, the price has gone up to more than that. So now it would cost close to 900 ounces or so. But that's Northern California, right? So Northern California real estate prices have appreciated much, much more than other parts of the country. Where my parents live, they bought their property around the same time. I think they paid slightly less. Actually, I don't remember what year they bought it. Might have been 1971 or something like that. 71, 72, in that neighborhood. They did a lot of improvements, but I think they paid $24,000 for their house. And the price of gold at that time was, this is right at the tail end of, so this is after came off the gold standards, but it looks like it was about $70. So 24,000, let's just use $70. That's 342 ounces. 3124-ish. That'd be about $1.7 million today. And that's probably a decent representation of what you would buy their property for today, more than a half a century later. So in gold, so they live in New England. So gold is definitely, it is a tested store of value over time. I actually was looking at one other thing today, which I found to be absolutely shocking, which is that over the course of the last 25 years, it has been better to keep your money in gold. And once upon a time, when it was legal tender, you could have put gold in the bank and earned interest on it. And if you compare how it has done relative to equities, since, let's call it 2000. I think that's what I was looking at earlier today. All right, normalize that, and boom. It's outperformed the S&P. This is not including dividends, so it hasn't outperformed it by quite that much. But, I mean, that's just shocking. And, you know, there's a reason. Here's a reason that you could look at. I think I have. This is the growth in the money supply, the number of dollars that's out there, right? I'll go back to 1970 since that's kind of the time frame that we were. This chart only goes back to 1980. But when you print money, the value of that money goes down because you can't print land or houses, but you can print the stuff that's used to buy them. And you can see that over the course of this period of time from 1980, there's also some quirky tax stuff that goes on in California. I don't want to get too far down a rabbit hole, but that also has impacted the value of housing here quite considerably. Prop 13, you can look it up. It's a tax revolt that took place in the late 1970s. So we can see that M2 was 1.6 trillion, and now it's 21.7. So a 13.6-fold increase in the money supply. And that's going to have an impact. That's going to have an impact. Okay, so while we're on the topic of gold, though, I should probably say this, which is that I was stunned also to see that every technical indicator I could find was basically bullish here, which has me a little bit worried. You know, last Monday I had said I was looking for a pullback. I have some silver call spread risk reversals on. So because I think silver has it has not even tested the the recent highs, and it has lagged gold considerably. So as a catch up with trade, I actually have a minor long silver position here. But it's not, the correlation between these two is imperfect. But I do feel like it's due to catch up. It has industrial uses, and it's just really hard to chase gold here. So let's take a look at this really quickly. So if I look at a long term, I'll go back. Why not? We'll go back to the 99. And we'll look at, actually, this one, I don't know if it's going to go back that far. It's only going to go back to 2000 because actually there's a lot of data points and it won't let me pull up all of them. So give this 1 second. And in the meantime, I will come over here and I'll run, so this is going to it's going to chew through a big set of technical indicators, and we can use them daily, weekly, or monthly. So I'm going to look at daily, weekly, and monthly, and then we're going to compare them. Okay. There we go. So that's the daily one. This is the weekly one. Here too, I want to go back 25 years, and then I'm going to go to the monthly one, and I'm going to go back a comparable amount of time. And so here we go. You will see the technical indicators over here on the left. So daily, going back 25 years from best performing approaches to worst, almost all of them are bullish. Weekly, so the moving average oscillator, Bollinger Band, and trading envelopes are stretched, suggesting it might be a little bit stretched. On a weekly basis, all of them, green arrows up, every case. Monthly, all of them, green arrows up in every case. This hockey stick thing we got going on right now, it's awfully tough to chase this as far as I'm concerned, because I kind of feel like the washout from this could be a little bit painful. And like I said, it's, if you hold it, because it was in my live stream acronym Rising, it was the last G in it. So if you hold GLD, I still like gold. It's great that it's doing this well. But, when things start, going up exponentially, I always get a little bit anxious. What am I looking for, by the way? What's the trading action that is going to freak me out more than any other? It's that downside reversal. What am I talking about? We open at fresh highs. So it gaps open to all-time highs and then closes lower on the day. To me, that is absolutely one of the scarier propositions, something I learned on my days on the NYMEX. So I would definitely look to lighten up. Again, if you followed the advice that I provided at the beginning of the year with the acronym to be long gold, that's fine, but I just keep that in mind. If it gaps higher, so price jump higher, hits new highs, and then closes lower on the day, might think about reducing the position somewhat. Take some of the profits at that point. Okay, so we've chewed up an hour, so I'm going to try to get to a couple more here. In a 1/2 or a 2/1 put ratio, if the stock drops, I'm assigned at the short put strike, not the lower, despite a lower break even on the entire options trade. Isn't my cost basis just the short strike? Yes, that's where you're going to actually have bought it. That's correct. So if I have a 190 1/2 put spread on, and it drops down to $98 on a one lot, I'm buying 100 shares at $100, $10,000 outlay. That is indeed that's going to be your basis on the stock. That's where you're purchasing the stock. Now, of course, you may have had a net debit when you initiated the spread. You may have had a net credit when you initiated the spread. So the other things are going to play into the tax consequences related to your options trades. But your basis on the stock should be the price at which you purchased it. In the same way that if you sell a call and you get called out of an underlying stock position at the strike, that's going to be your selling price. Is there a trade for Wednesday or Thursday after the relief of tariff news when implied volatility should come down if there is a finality? So let's just quickly observe. Whoops. All right, it is working. This is interesting. Somebody made the observation last week, and we can see if this was actually true. We can wind back the clock and see that the implied volatility that was baked into the cake associated with the tariffs was lower than the event variance that was associated with the economic data that came out last Friday. So let's go to 2 business days ago and see what we've got. Well, that definitely doesn't seem to... Oh, you know what? So, yeah, the other thing is that when you're comparing volatilities, you may want to be able to compare like for like. So we would actually need to look at these on a specific strike basis. So let me pick a... to do that, I have to make some quick adjustments here. Hang on. So where were we on Thursday? So we were at, so that was Friday. Thursday we were at close to 5,700. So, and now we're close to 5,600. I'll just use the 5,600 strike. That's probably good enough. So we're going to use the 5,600s. And this is just so that I can compare like with like. Oops. Oh, not letting me get there, so I'm just going to put the 5610s. Why not? And is that actually... Well, it doesn't appear to be true. I think I saw that on Bloomberg. I overheard somebody say it, so I was looking at it. It's not necessarily true. But yeah, there is a bit of implied volatility here that could come out. And, you know, like I said, I don't have any hedges on myself right now because I feel like a lot of stocks have gotten to a more reasonable valuation. I also don't think that, I don't know that there's as much uncertainty as some people are suggesting with respect to the policy proposals because they've been articulated repeatedly so many times. I still have a lot of uncertainty with how it's going to ultimately end up playing out. As I previously mentioned, on autos, for example, I had hoped it was a negotiating tactic because in Europe, for example, the tariffs that we are subjected to, and I do think it's appropriate for us to match them, are, I think, on average about 10%. So the 25%, and I know this business about VAT taxes, I keep coming back to this. I don't know why they're incorporating that. I don't think they should, but I thought maybe that's a negotiating tactic. And so from my perspective, there was always the possibility that they would meet somewhere in the middle. Maybe they would come, they'd say, we impose 10 and we'll take it down to 7.5 and we'd meet them at 7.5, which would be vastly different than the 25% that's been proposed. And I think the market would rip if we got news like that. But it doesn't seem like Europe is budging very much. That's a little bit troubling. And, the other thing I would say is that one other set of policy issues that are going on right now, which could spur some spending and investment, I guess, in Europe, is this idea that other NATO countries are going to start pulling their fair share of NATO military spending. And that could be a lot, right? Because Germany has underspent by huge sums. They're supposed to be contributing as 5% of their GDP or whatever it is, and they haven't been doing anything close to that. And theirs is the largest GDP over there. So this would, that would really be meaningful in terms of sort of ramping up the spend at the European defense contractors like BAE and things like that. And one of the other byproducts that I've heard people discuss, and I think it's not entirely unreasonable, is that you cannot claim that the United States has exhibited all of this exceptionalism. You keep hearing this. Can United States exceptionalism continue? Well, United States exceptionalism, if we're measuring it as a function of GDP is also a function of government spending. And government spending has been fueled with record deficits. So if we start to bring our deficit down, there's not any way I can really see us doing this without slowing the economy somehow. And if they start bringing theirs up, Germany, I think, can afford to do it. I think their debt to GDP is something like ours was pre-2008. Then they're going to be doing what we have been doing, right? That's just how it works. If they increase government spending and increase running deficits and things like that, well, then they're essentially going to have the adrenaline shot pumped in terms of government spending that we have had for several years at the exact same moment that we are saying we're not going to do it anymore. So it's kind of, I'm saying it in a very simplified way, but it's something to think about that's outside of just the tariff equation, because it's not the only piece that's moving on the board. And Spicy Barbecue said that he sold the 94 put. So remember when I was showing that version of that put spread, the ratio one, the 1/3, he was short the one in long, and that was the last picture that I showed. And I think it should hopefully still be in here. Oh, whoops. It's not. So this was going to be short the 94s. I'm just going to put the 95s and then put buying the 90s. So 1, 2, 3, short this, like this. And now that's the picture that you get, right? So you're squeezing the balloon a little bit, giving yourself more leverage to the upside. This is not going to have the big capital requirement that doing the inverse, as I previously said, would have. And that's really the way to think about these things. What you're doing is you're taking a long put and modifying the structure a little bit, squeezing a little bit more juice out. And if you do the inverse, it's the same thing. Whether you want to do that's going to be a function of skew and vol. Okay, let me see. I'm going to quickly scan through here. Some reasons I would guess gold is more trustworthy, less regulatory risk, less technology risk, better understood markets and participants, among other things. It's a more mature market. The other thing about gold is that there's just been massive bank buying. We've been hearing all of this. Gold is physical gold is changing hands. Banks are moving gold around. In addition to that, there's been very high levels of, the COMEX gold futures are typically a financial instrument. Of course, they settle to the underlying metal, 50 troy ounces, and then the silver futures to 5,000 ounces. But generally, people close their positions most often before they expire, the futures, that is. And there's been more physical delivery. And that, I think I've previously pointed out that physical delivery is also bullish. When I start seeing really bullish activity in the spot market, that's the physical. That's, in metals that can, not in metals, excuse me, in commodities that can have supply and demand imbalances, this is when you would normally start to see things get into backwardation. So if you saw a lot of folks taking physical delivery of a physical commodity that is not as accessible as gold is, you would sometimes see the curve shift down. So the near end would be higher than the back end, and that's a bullish tendency. And we're seeing that exhibited. So all of that physical delivery, that continues to be bullish. but keep an eye on that downside reversal. For those of you who are in it or who followed my recommendation at the beginning of the year to be long gold, or the beginning of last year, because that was part of my my brave trade. Anglo Gold Ashanti was in my January 2024 best ideas for last year. Okay, so like, subscribe, notification bell. I think I answered some of the questions that I had previously missed. And if I didn't, it's not because I don't try to answer them. It's just because I am long-winded and talk about things and go really into it. So just hit me up again. I'll promise I'll try to get to them. Yeah, if the questions occur to you that you didn't get to this time and you want me to try to answer them on Wednesday, and I think Brian Stutland's going to be back for that, by the way, because he's been traveling. But hopefully he's going to be joining us on Wednesday. Put those into the comment section and join us on Wednesday at 4:15 Eastern, and we'll try to answer them then. Until then, hang on to your hats, and thanks for watching.